Alright guys, Macroeconomics 14, excitement is over. Actually for commercial banking, and what we're doing, the excitement was on Friday while we were having our last lecture. Bear Stearns, have you guys heard of Bear Stearns? It is a, let's try to spell it out. Bear Stearns is a major Wall Street bank. Wall Street banks are typically categorized as commercial banks and investment banks. So investment banks, and this one is an investment bank, deals mostly with issuing securities and underwriting. Underwriting a security means that the securities firm or the investment bank takes the responsibility to finance a company, whether through issuing stocks or bonds, and later on to resell those securities to the market. So Bear Stearns is one of the oldest investment banks on Wall Street. It has survived through the Great Depression. The fifth largest, so it was worth well more than $20 billion just a few months ago. And on Monday, meaning last Monday, there was a rumor or fear that Bear Stearns may have some problems. Of course, the problems are associated mostly with liquidity problems. Again, people might even fear that the bank might not have enough capital, but that's not the point. The point is that the market got a little bit scared that Bear Stearns may have problems, some problems. So, some other investment banks and from other countries, etc., started to just not trade with Bear Stearns. Other, especially commercial banks, got scared that in times of scarce capital, where, during the credit crunch, capital liquidity is getting very scarce, commercial banks decided that they should probably pull out their money out of Bear Stearns. Not because of the fear that they're going to ultimately lose it, but because of the fear that if Bear Stearns got major problems, their capital might be locked up for days or weeks or months, or in a major bankruptcy even longer. So on Tuesday, the cash position, meaning the way we studied the reserves positions of Bear Stearns, was somewhat deteriorating. This kind of spread the rumor that their position was deteriorating, and the CEO went out on Wednesday on TV to the whole world and declared, Bear Stearns is in great shape, we got all the reserves, everything's fine, there are rumors, they're unsubstantiated, there is no truth to them, we are in great shape, we are, don't forget that, one of the greatest Wall Street banks, and all the great stuff. Of course, on the one hand, he was just plain lying through his teeth. On the other hand, he couldn't say anything else. But even though the CEO goes on TV and everything he says and claims is perfect, on Thursday morning, meaning the next day after the TV, again, you got to understand what is the psychology. That's extremely important. And that's also a good advice that you'll have to learn and remember. Anytime you see someone from a bank, especially executive, telling you the bank is not in trouble, you gotta rush immediately to the bank, and you gotta rush before the others rush to get your money out.
So it's not psychology of all people. He's not that stupid to say that. It's not psychology of every person.
Whatever. He has to come. He says everything's fine, everything's great, no problems. We're safe, we got all the reserves, we're concerned all the great stuff, and on Thursday morning of liquidation. So a deluge where people are just, meaning other customers are pulling out their money out of Bear Stearns. Now, in a commercial bank, as we have been studying so far, these are just ordinary depositors, probably households, possibly these might be businesses. In an investment bank, you'll have other institutions, could be pension funds, possibly hedge funds, it would be of course commercial banks, it will be other investment banks. Whatever the case, if they got 10-20 billion in assets, they must have 10-20 billion, the respective amount, in liabilities. So on Thursday morning began the massive bank run, and you gotta guess how long it lasted. It lasted a couple of short hours. By 1 or 2 o'clock, it is clear that the institution is bankrupt, at least technically bankrupt, and they had to pick up the phone, call the Federal Reserve, and say, "Uncle Ben, we're in trouble, please save us," or "You gotta save us, because if you don't save us, the whole financial system is going to collapse." So Uncle Ben comes with a nice plan to save the bank. Well, the plan was to tide it over for a couple of days. Ben Bernanke gave him like 28 days financing through JP Morgan. They resorted to some legislation that was enacted during the Great Depression, so that the Fed, as is the law today, and it has been for 80 years since the Great Depression, and even before that, since the Federal Reserve Act, the Federal Reserve can finance only commercial banks. So if it's an investment bank, it's got to find a commercial bank that will borrow from the Fed and channel the funds. Well, no commercial bank is stupid enough to do that, because they borrow like $5 billion, they give it to Bear Stearns, of course the Bear Stearns goes bankrupt, and then the commercial bank collapses with it too, all right? So if that's the case, of course no commercial bank would want to do that. The only way that it will happen is that the Fed will actually guarantee the losses of that intermediate commercial bank, which was JP Morgan. So JP Morgan became the savior through the Federal Reserve. Well, as the markets lost confidence and everything was going really bad, because it's not just, you know, the question, well, if Bear Stearns is a terrific bank, legendary or well known for its risk management, and they got in deep trouble, maybe probably a whole bunch of other investment or commercial banks are in trouble. So suddenly the markets got scared, and then the Fed's got to find the longer term solution. The longer term solution was calling up JP Morgan and say, "Hey, do you want to get these guys dirt cheap?" Of course the answer is, how dirt is dirt cheap? And they just say a couple of pennies, like 5 pennies on the dollar. So $20 billion bank that was at least 20 billion valued a few months ago, JP Morgan got it for 200 million, so they got it for like 1% of its market value from a couple of months ago. Essentially, the stock was like 200, then it drifted lower and lower and lower and lower. Before this crisis erupted, it was at $50, so it already lost a lot of value. And then on the day of crisis, the stock fell from 50 roughly to 25, and then JP Morgan bought it on the next day, meaning during the weekend, for 2. All right? So this is how rapidly a bank, a commercial as well as an investment bank, can collapse in a spectacular blow up. And everybody on Wall Street is shocked. All right? Well, there's nothing shocked if you just read and study this kind of stuff. It's simple. Usually, a financial institution has hard times surviving even one day of a classic bank run. Well, on Saturday and Sundays, and including Mondays, everyone was admitting and saying on TV, articles, etc., that this was a classic bank run. And the bank run essentially collapsed the financial institution literally in hours. Alright, is this good enough? So, move on to central banking. So, what's central banking doing or function? Topic. Well, central bank has been designed in the first place with the fundamental, let's say, reason for its existence. It's called raison d'etre, to save commercial banks. In other words, the central bank is of commercial banks, by commercial banks, and for commercial banks. So, the central bank's first main function, so it has functions. The first main function is always to protect. To protect commercial banks. So, this is what the job of the central bank is. It is the mother, and commercial banks are their babies, so it will do whatever is necessary to save its babies. Of course, if she's got 30 of them and one's got to go to save the rest, so be it. The one is sacrificed for the benefit and welfare of the rest. The second fundamental function of the central bank is to finance the government. Is to finance the government. Now, this is what is the reality. So this is what every central bank is all about. Now let's learn some of the myth, which is properly called with the word propaganda. So what are we typically told that the central bank is about?
Printing money.
No. Central banks will never ever tell you that they are in the business of printing money. No.
Interest rates?
I can't hear, sorry.
Interest rates.
Interest rates, yeah, but that's not what they're really about. First of all, they will tell you that we always try for financial stability. Second of all, any central bank in the world will tell you one thing, that their primary goal is always price stability. Alright? This is known and is usually said in the propaganda, is that the Fed, or the central bank, is an inflation fighter. As we started, you got to understand, the reality is exactly the opposite. The central bank's job is to inflate. Its main function is to inflate. But it is nevertheless said and popular that its job is to fight inflation. Well, no, certainly not. Now, they will pretend and talk as if they are fighting inflation, but that's not what their job is about. A separate item that they like to call is stable currency is another typical myth. Well, you gotta understand, stable currency is more or less synonymous with stable value of the currency. And stable value of the currency means stable purchasing power of money. Well, stable purchasing power of money is incompatible with inflation. You can't just inflate and inflate and inflate and keep inflating and have stable purchasing power. That's impossible. So you're told that stable currency is a goal, but in reality it is not, because the bank, central bank, and commercial banks and the government don't get anything from stable currency. In other words, the interest of commercial banks and the government is a steady erosion of the purchasing power of the currency, which allows a steady inflation, which allows the extraction of that inflation tax. It is all about the inflation tax. So, I can go on and on with a whole bunch. I'll skip those. The issue is, how does the central bank secure these goals? All right, question.
Can I ask you a question about the myths? I agree with the second and the third one, but what about financial stability? Like, maybe central banking, in the case of bank runs, helps to preserve financial stability because it helps the banks from going bankrupt. And it
well, again, this is again the illusion. This is again the illusion. It's kind of like saying the following logic. If we allow people to live a very unhealthy life, all right? They eat all the junk, you know, party all night long and all the bad stuff that they do. And then, you know, we first create the bad, unhealthy lifestyle, and then we say, yeah, but we desperately need a doctor because the doctor is gonna drug them up when they feel the pain. So when they feel the pain, the doctor just shoots up a little bit of narcotics, and that at least temporarily fixes the problem. So financial stability is in the interest of commercial banks, because if there is financial stability, it prevents the bank runs and it prevents commercial banks to keep on doing whatever they're doing in order to extract that inflation tax. All right, I mean, you first suppose that there is a central bank, then you suppose that bad things happen, and then you suppose the central bank fixes the problems of the commercial banks. You see, that's again, it's kind of like a fallacy of composition. You already assume there is a central bank, and then the logic fails. Well, what if there is no central bank? Well, there will be the occasional run here and the occasional run there. But the problem is, and it is well known in economics, it is called moral hazard. Commercial banks, knowing and understanding that there is a central bank to protect them, do not have to behave prudently. Quite on the contrary. They can behave, when they do in real life, behave extremely aggressively, trying to exploit and milk the system. They do all sorts of crazy and wild stuff, and they simply know that the central bank will not let them fail, usually because this will, this will fail in a domino-like fashion the rest of the financial system. So, you see, it's kind of like saying, I can eat all the junk in the world and I don't give a damn because I have a doctor who's going to fix me and a health insurance that will pay for the doctor. Alright? It's the same type of logic. I mean, same thing, moral hazard might apply with let's say, house insurance. You can just, you know, you got your house insurance at home, and you can go to work. You can keep some of the electrical appliances on. You're going to say, I don't care if the house goes. I got house insurance for, you know, against fire. All right, so it's a fire insurance. So this is what's called moral hazard. And once you have the central bank, the mere fact that it exists and the mere fact that it is implied or understood that it's going to save, the word in English is bail out a commercial bank in trouble, provides the wrong incentive to do a whole bunch of bad things. Moreover, it provides the incentive for all banks to rush and do the stupidest of all stupid things, all right? I mean, that's how it works. Same thing in Bulgaria today. I guess probably in Russia, or at least until recently, our banks are doing all of the craziest things in the world just to gain market share. No matter how bad the customer is with all the other stuff. So, moral hazard is a consequence or result of the existence of the central bank, whose job is financial stability, and financial stability implies that when a major bank gets in trouble, the central bank will bail it out. So usually, the bigger the bank, the more reckless it is. Like Northern Rock, I mean, they were a giant, they were a monster, and they just knew there is no way that the government will let it go bankrupt, because in a domino-like fashion, the whole British banking system will completely collapse. So, one of the lessons, at least from there, is if you're going to get in trouble, you'd better be big. Because if you're big, the government, meaning the central bank, or government jointly with the central bank, will bail you out. But if you're small, they might just let you go bankrupt. Alright? Is that so far fairly clear? Alright, so that's moral hazard. Let me see what next I'm going to try to do. Well, let's remember what was the first limit to credit expansion. So now I'm beginning to work on the subject or the topic that the central bank exists for the one major purpose of removing the limits to credit expansion. The removal of limits to credit expansion is also part of protecting the commercial banks, and by protecting, I should add a separate part in here, and enhancing their profitability. In other words, the central bank doesn't just appear out of the blue. It's usually commercial banks organize themselves and they set up for themselves a central bank with the blessing of the government. Again, why would the government bless it? The answer is because the government will have the central bank in control and will be able to extract benefits for itself. Well, what is the main benefit of the government from a central bank is that whenever the government wants to issue debt, it will be always bought by commercial banks, and in case it is not bought by the commercial bank, they always have a buyer of last resort, which is the central bank, and the central bank, if necessary, and always has been that way through history, will simply print up the money to finance the government. Of course, it's not just going to give them away, it's going to give them for a government bond. Technically, it will be a purchase. Central bank will purchase a government bond to finance the government, but the genuine economic meaning is simply that of printing the money to finance the government. Well, that type of printing money to finance the government is called, well, I kind of got carried away. Let me write it on this side. Monetization. So, monetization is the purchase of any asset by the central bank, which it pays with freshly printed money. The central bank may monetize a house, meaning it buys the house, prints the money to pay for it. It may, well, typically monetizes government bonds, so it buys the bonds, it prints up the money. I mean, you gotta understand, what else can the central bank pay with? The only way it can pay with is print up the money. It's got no sources of revenues, nothing else to support it. Plus, it was designed in the first place to monetize different assets and thus increase the overall money supply in the economy. All right, so number one was use of money and deposits, which is the same as banks, commercial banks. In other words, people will put their money. This was the first limitation, typically. So, the government provides a special monopoly to the central bank, the monopoly to print money. So, usually, this will be done by commercial banks themselves. Why would commercial banks want to relegate this authority to the central bank? Because if 2, 3, or 5 commercial banks print money, they are subject to competition. When they move that authority to the central bank, and only the central bank, and no one else is permitted or allowed to print money, they shield themselves from the competition of money. Okay? So that's number one. Number two is what I already mentioned last time, legal tender laws. Legal tender law simply says that the money that the central bank has a monopoly over shall be the one and only legal tender. This means that you must pay with it, and again, if you have someone owes you money or debt, that money, the government's money, meaning the central bank's money, is sufficient to satisfy the debt. In other words, if you owe me 500 lever and you bring me 500 lever, I cannot say I don't want your 500 and I will not accept the 500. I want dollars, or I want euro, or I want gold. For example, if I want for my payment from the university gold, certainly the laws will not allow it. The university, if they want to pay me with lever, they can pay me with lever, and I'm powerless to do anything because they have the power of the law, the legal tender law behind it. So these two together provide for the money side. Okay? Is that fairly clear? So, in other words, you first create for yourself monopoly. You're the one and only who has it. And then you do not permit anybody to use anything else, and then you force anybody to use your own thing. I mean, that's as good as it gets when it comes to pure monopoly, all right? So, the use of money. What about the use of deposits? Well, the use of deposits, usually the association with the central bank, is that they create some sort of an aura. You know what's an aura? I mean, you kind of like have a saint, and they'll have this aura, or some other spiritual or biblical heroes, and you create an aura around them as if they are godly creatures. Well, so is the idea of the central bank. Central banks are surrounded by this aura, and this aura provides for infinite level of reputation. I mean, it's kind of like, you know, you talk with somebody from the central bank, you're talking like with God, all right? So, the next thing is reputation. The idea of the reputation is as simple as, well, the central bank can print up as much as it wants, so it can technically never, ever go bankrupt. So that's one way to think about it. Now, the second way with the aura thing is, you have the smartest and the brightest guys working at the central bank. The third thing is, you always hear constantly that the central bank knows exactly what they're doing. Well, in reality, most of the times, most of the people in a central bank are just well-connected bureaucrats who have no idea what they're doing or what the consequences of their actions are. But nevertheless, you know, this is this aura. He works at the central bank and he said something, right? As if they know. Usually, they just take a stack of papers, they staple them and push them to the next bureaucrat. But it is the aura of working at the central bank. All right. So these three take care of this number one. All right. Is that fairly clear? Now let's discuss number two, credit expansion. And the limit to credit expansion number two was bank runs. Was it? Is this how we wrote bank runs number two? So, let me use blue arrows as I have been using blue arrow. So, number one. Because they're a central bank, the central bank guarantees, I mean, it actually provides financial stability, but because the central bank guarantees financial stability, bank runs are a lot rarer. Doesn't mean they disappear. We just had one 4 days ago, right? And Northern Rock was just a couple of months ago. So, financially stable or financial stability certainly helps to prevent bank runs. Again, remember, this is fractional reserve banking. They're not financially stable, but they create the illusion of financial stability. You know, what is it? Central banker and then Minister of Finance keeps constantly coming on TV. Bulgaria's central bank is stable, it is rock solid, see all the great results and everything, and they keep bombarding us with propaganda that everything is fine and that there are no problems. Just like the CEO of Bear Stearns on Wednesday, and then on Thursday it was bankrupt. Well, of course, financial stability / propaganda is always a good tool, but people, as happened with Northern Rock and with Bear Stearns, just don't trust the propaganda. I mean, people, you can fool them for some time, but eventually you can't keep fooling them. So the second thing is called, and I'm going to write it in red, is called LLR, which stands for Lender of Last Resort. So, lender of last resort, this is the central bank. So, the second way the central bank prevents a bank run is by acting as a lender of last resort, which means that if a commercial bank gets in trouble and runs low on reserves or simply cannot meet redemptions, the commercial bank is usually supposed to borrow from somebody, to borrow from anybody, usually from other commercial banks on the what's called interbank market. So Bank A goes to Bank B, says, hey, I'm in trouble, give me $2 or $3 billion. Well, last resort means if you cannot borrow from anybody in the economy or from anybody in the world for that matter, you can go to the central bank and it will lend you the money if you can't get it from anywhere else. Alright? So, to lend you the money is the same thing as lending you the reserves. So, it's going to give you extra reserves with which you can continue to to satisfy the rush of redemptions. The fundamental idea is that if it is absolutely necessary, at least theoretically, the central bank will provide all the reserves necessary to redeem every single, at least short-term liability or short-term demand deposit. So, the idea is there is no point for a bank run because we shouldn't even fear about our money, because even if there's trouble, the central bank is just going to give it to them.
Does the central bank have to give them money? And can it not do it if it sees that the situation is...
Alright, so the answer to this question is yes, the central bank has no such responsibility, but usually the mentality is that still of the mother towards her child. She's got 4 children, sees one in deep trouble, she may have to sacrifice some or a lot and still save her child. By law, it is not necessary, but by practice, it is customary. Remember, even though we're not taught this, that's what the central bank is really for, to save that bank. Of course, it will save the bank with some sort of a punishment. It may be an extra, let's say, higher interest rate. It may actually provide a stigma to the bank. It may tell other people what not so that they don't use... I mean, there are all sorts of other ways that, just like the mother can punish her, poorly behaving child, so can the central bank punish a badly behaving commercial bank. But it is not necessary, but it is assumed to be so. Now, let me add number 3, but it is very important for you to understand that this is not part of the central bank, but it is part of the government. So it is usually part of the government, but not usually part of the central bank. It is called, let me put it in red again because it is a term, FDIC, which stands for Federal Deposit Insurance. The C is corporation. So, this in simplest term is deposit insurance. What is a deposit insurance? Deposit insurance is a usually government guarantee, not central bank guarantee, but a government guarantee that in case the bank, commercial bank goes bankrupt, the government will guarantee in case of trouble or bankruptcy or any other problems to return a deposit to the depositor up to usually a specific amount of money. In Bulgaria it was 10,000 leva, then they increased it to 20,000 leva. Now within European standards, harmonizing Bulgarian commercial banking regulations with European commercial banking regulations, it is 20,000 euro, and for the US it has been for the most part, let's say $100,000, and occasionally they may be $1 million deposits.
How do you find this number? How does the government decide?
Well, the government decides whatever they think it will provide additional safety. Again, they don't care about strictly the safety, they care about the system, banking system not collapsing. You got to understand why. Because governments, all governments, and correct me if you know one in the world, all governments are always in debt, deep in debt. So governments are always, at any point in time, desperate to borrow. If the banking system collapses, the government collapses because the government cannot borrow and therefore cannot spend immediately. You understand that concept? So governments have always, because they're always debtors, huge debtors, they have inherent interest to maintain financial stability, because banking system freezes, the government freezes. Had a question? Yeah.
If, for example, a certain bank goes bankrupt and people who deposited their money lose this money, the central bank will cover some percent of the money they deposited by printing.
Okay, I never said the central bank. It may be the central bank. In real life, it's rarely. It is the government itself. So, now how does it work? Two ways. Number one, there is a fund, depositors fund. And that depositors fund usually is accumulated or grows by, because it's insurance, we call the money that banks contribute, we call it premiums. So this is a fund which is made out of bank premiums on their insurance. In other words, every commercial bank will pay a monthly or annual premium to that insurance fund. It acts as like any other insurance company, like any other guarantors. You pay a premium, they guarantee something, all right? So usually the money will come out of this fund first. Now, in the United States, this fund is probably 0.5 or 0.25% of all deposits. One big bank like Bear Stearns, well, it's got to be a commercial bank though, one big bank goes bankrupt, and the fund, the guaranteed deposit insurance fund, is bankrupt, all right, because it's tiny. In Bulgaria, this is one of the greatest myths ever, and I've heard it 1,000 times, of course, from people who know nothing, that, oh, our money's perfectly safe in commercial banks simply because there is a government guarantee. Well, the guarantee, which is the guarantee fund, is in Bulgaria, is, again, between 0.25% to 0.5% of all deposits. Usually, it's just easy to compute, everyone, at least in the business, you know, who knows and understands about it, understands that one single mid-sized bank, bankruptcy, will bankrupt the insurance fund itself. Two small banks will bankrupt the insurance. Of course, it can't even handle a top bank altogether. But people believe, meaning people are fooled into believing. And again, this is a classic propaganda which so far works. It doesn't always work. I mean, you gotta understand, with Northern Rock, the UK government said, yes, don't worry, it is stable. They rushed to the bank. They said, don't worry, we guarantee it all. There is no problem. And they nevertheless went and pulled the money out. Why? Because British people aren't that stupid. They have learned that governments usually don't keep their promises. This is the rule, right? So governments are in the habit of, let's say, lying to people. So they usually, people just say, let me just go ahead and take it anyway. If they guarantee it, well, let them put the money and guarantee it, all right? I just don't want an empty promise. I want to see a bag of cash and move it over elsewhere.
If the government says it will cover only small amount, let's say $1,000, does it mean the government thinks people believe in financial stability of the country?
Well, the idea is the following. Here is at least what's called the rationale. If we guarantee in the United States $100,000, if you or she has $500,000, which is $500,000, you're rich. You can take care of yourself. If you got a 500, meaning $500,000 deposit in the bank, you probably didn't get that kind of money and you just don't keep your money in a deposit. You also probably got 1 or 2 million investments in government bonds, in stocks, in gold, in real estate, in a whole bunch of other things. In other words, you're rich. Still, it is also assumed you got that kind of deposit in the commercial bank, a deposit. You're probably financially savvy and sophisticated, and you can take care of yourself, all right? So, if some rich guy loses their money, loses $1 billion, no big deal. There's a billionaire, and now you gotta understand, this Bear Stearns was like worth $20 billion. It goes technically bankrupt, meaning it's still worth 200 million, but there was a billionaire, and that billionaire got like 7-8% of Bear Stearns owned the stock. He was like a major shareholder. Well, he just lost in a couple of minutes $1 billion. Well, no one is sorry for the billionaire because he lost $1 billion. He's got a couple more billion, who cares about it? It is the same type of logic. CITIC is another major investor in Bear Stearns. This is China's investment corporation, which is kind of like sovereign wealth fund, which tries to invest China's financial reserves somewhere abroad. Well, they got like $1.5 trillion, meaning they have well over $1,000 billion. Just because these guys lost $1 billion, it's peanuts for them. Who cares about them? So it is the same logic. Government says, we care about the small people, those that have 2,000 or 3,000. We want to protect them. Those that have $1 million, well, first of all, they're probably safe otherwise, and if not, they'll make again $1 million. No big deal. So that's the typical logic. Is it kind of answering the question? More questions? Any? You're having fun, right? All right.
But if they don't care about their money, I mean, businessmen and companies, they won't invest money in the economy.
Oh, no, wait a minute. All we're saying is this is money which is parked temporarily in the bank, possibly to pay 4 or 5 days from now the salaries of workers. You see, again, businesses are typically in debt. Whenever they see a little bit more money, they usually use it and immediately pay down debt. Again, if they don't have debt due today, but they probably have on January 1st, they'll buy some government securities or some other investment instruments that will mature right before their obligation. So their money matures and then they'll use it to pay down. Again, you have to understand that because a business has money, by all means, it does not imply that its money is simply in a commercial bank deposit. You understand the difference?
Okay, but I may have, for example, accounts receivable, and when I lose it, I lost my money, actually.
Well, but the point is you get the accounts receivable, but the question is from whom? From the commercial bank?
From anywhere, from my customers, from some revenues, I don't know.
Well, but that's the point. The commercial bank and the central bank, the government, guarantees 100,000. So, if you're a small fish, meaning you're a small business and you got to collect 2,000 here and 5,000 there, no problem, you're covered. If you are IBM or Microsoft and you do lose 5 million, again, no big deal. I mean, these are peanuts for Microsoft. You see, 100,000 is sufficiently large to cover individuals, sufficiently large to cover small businesses, and if you're a big business, then no big deal. You know, $1 million or $2 million loss is not a really big deal. I mean, these guys work with 100 million, 200 million. So, 500 million. So, you lose 1 million, no big deal. But the point is, corporations that are of large size usually keep only modest, and I mean truly modest amount of money in deposits. Also, something else. If you're a money manager, for example, could be, let's say, for our university, and you're trying to keep, let's say, $500,000 in cash, you know, to pay for the construction, salaries, students, whatnot, I mean, there's a whole bunch of stuff. You could take or get an extra protection. And you could get a protection for your deposit up to 1 million. That's a possibility. It exists, okay? A third way to go about it is you get your, let's say, 1 million deposit and you slice it up amongst 10 banks. Alright? So you diversify. Alright, one bank goes bankrupt, you know, you lose a little bit. Let's say you put it in 20 banks, 50,000 each in each bank. One bank goes bankrupt, you lose 50. You're still fine. Meaning, you're going to lose some, but the problem is it's lose some, all right? If 20,000 euro is the deposit, which means 40,000 leva, and you deposited 50, and you lose 10,000 in a bank bankruptcy out of 1 million in deposits, you're fine, all right? It's no big deal. So, is this kind of answering your question? All right, more questions. Oh, well, we still have a lot of stuff to cover. Let's see, any more questions? All right, so FDIC or deposit insurance is another way, and there is still another way for bank runs, at least legally, and most central banks do enforce it quite strictly and pedantically. Otherwise, even in some corrupt countries, bankers will go to jail, is minimum required reserves. Minimum required reserves. Now, minimum required reserves, let me also add this. Remember, we had three major limitations to credit expansion. One was use of money in deposits. Central bank takes care of it. Number 2 was bank runs. And number 3 was reserve draining. Reserve drains. So, minimum reserve requirements, let's call it again, the same old story, the same word, confidence, instills confidence in the bank, commercial bank, and they say, oh, they have to maintain minimum reserves, which the translation is, they always have sufficient money on hand, but also minimum required reserves takes care not only of the problem of bank runs, but also the problem of reserve drains. So, as long as one bank starts expanding a lot faster, and it starts losing reserves, it will hit minimum required reserves. Again, minimum required reserves is usually imposed by law or by regulation, usually by the central bank and enforced by the central bank. Alright? And the minimum reserve requirements act like the parent who tells her, let's say, teenage girl, be back at home by 10 o'clock or you'll be punished. Alright? So, if the parent says, be back home at 10 o'clock, it's the same thing as central bank saying, you gotta maintain a minimum of 10% reserves. So, this is about imposing rules and regulations that will enforce a minimum stability or a minimum integrity in the banking system, and will also instill some confidence. Oh yeah, they gotta maintain the reserves. It also puts major restraints on excessive credit expansion by one bank, because as soon as it expands and loses reserves, it's going to hit minimum reserve requirements, and the central bank says, okay, you cannot expand. You got to rebuild your reserves, and then, all right? So, now, minimum reserve required reserves is also called minimum reserve requirements. So, both are used, they're used synonymously, they mean the same thing. Now, let me try to work out another moment, important moment of central banking that follows out of minimum reserve requirements. So, minimum reserve requirements have one very important implication. Given that you already have a central bank, given that you already have a lender of last resort, given that you already have an FDIC, monopoly and everything else, in other words, you have the typical modern 20th century central banking structure, and you got the guarantees and everything else. As soon as the central bank imposes minimum reserves, it immediately follows that commercial banks will be always loaned up. Let me explain what it means to loan up. Loan up stands sometimes short for loaned up to the limit, loaned up to reserves. Loaned up simply means that whatever your reserves are, you will always be working at the minimum reserves. Remember, reserves are the opposite or constrained credit expansion. If you say have 10% reserves, 10% minimum reserve requirements, and you have a reserves of 20, loaned up means that your deposits will be immediately 200. And if you get 25, you will loan up to 250. And if you get 30, you'll loan up to 300. So loaned up always means that no matter what the reserves, the commercial bank will always immediately expand credit to the point of hitting the reserve requirements. Does that make sense? So, for example, you're a commercial bank, you have certain assets, 1 billion, certain liabilities, 1 billion, and at some point you say, well, we gotta extend extra credit for let's say $100 million, an extra $100 million. Well, then the answer is, we gotta find extra reserves of 10 million, and when we loan up to 10 million with a 10% reserve requirement, you're going to get the extra 100 million. So, loaning up is a consequence of a number of things. Number one, banks do not fear of being loaned up because they don't fear a bank run. Okay? So that's number one. But loaning up is all a consequence also of profit maximization. So, a bank will always strive to have the maximum possible loans in order to maximize its profits. So, maximum loans will simply mean whatever the requirement, they are always going to be working on the verge of requirement. Is that fairly? Make sense? Is that clear? So, minimum reserve requirements means number one, they're loaned up. It also means number two, necessarily, that the expansion or the, again, it follows from being loaned up. It means that the margins, the reserve requirements are at the bare minimum. So it means that the multiplier will equal pretty much the inverse of the reserve requirements. Will equal 1 over minimum reserve requirements. So, let me provide an example. For a 20% requirement will result in a multiplier of 5. A 5% reserve requirement will result in a multiplier of 20. Is that fairly clear? Alright, so out of these we get to the next. Is that questions? What's the question? Any questions, guys? What is it? What's the question? Oh, well, that's not your job, that's my job, you know. Next time you're going to get 2 penalties, okay? Just a warning now. Alright, so we're back to money supply. So, these are some of the consequences. Now, the next question is money supply. So, what is the money supply in a system as is a more modern system? In other words, we're transitioning from gold into banknotes, and then we're transitioning now with a central bank and commercial banks, alright? So, what is money supply? And the money supply, the definition remains the same. Whatever can be used to make a payment. In other words, whatever can be used in an indirect exchange. So, let's see, we have it here in the okay, if gold is used in the public, will be gold in the public. This is the first component. If gold is used. If it's not used, this doesn't count, okay? Number 2, let's see. Notes. Banknotes. In public. Now, let me clarify one word which is usually used by a lot of economists, textbooks, newspapers, which is perfectly correct to use. Instead of saying in public, you could say in circulation. In circulation. This is perfectly correct. It has been used for centuries, okay? So, nothing wrong using in circulation. And now there is one third component, which, as you can guess or should guess, is demand deposits, or publics demand deposits in commercial banks. So, you can just call it commercial banks demand deposits, which is the same as demand deposits of commercial banks.
What is demand deposits? How is it different from deposits?
Okay, deposit is something you put your money in the bank. Let's try to do this here. Let's do this here. Deposits. The first type is called demand deposit. The second type is called time deposit. So these are the two major types of deposits. So deposit, we already clarified what it is. A demand deposit is always payable on demand. So whenever you walk into the bank and you demand it, the bank must pay, because this is the contract itself. This is the nature of the deposit. In a time deposit, the deposit has a maturity. It means that it has a certain time to pass or to elapse before the deposit is, or let's call it matures, meaning before the deposit becomes payable. So if you have, let's say, a 15-day deposit, time deposit, and today is, let's say, the 17th or 18th of March, and your deposit matures on April the 1st, then the time deposit is not part of the money supply, simply because if you walk tomorrow in the bank and say, I would like to get my demand deposit, or I would like to withdraw my demand deposit, the bank is not required to do so. There is no legal obligation. There is no agreement. There is no understanding. I mean, nothing would make the bank pay, okay? So, a time deposit does not count in the money supply, for the simple reason that if you have 1 million in the bank today in a time deposit maturing on April the 1st, you cannot use it for any payment. Sure, you could possibly use it to borrow against it, and if you borrow against it, you know, your borrowing will effectively create new money, but this money is locked up. And if it's locked up, you can't use it for a payment. It is not part of the money supply.
And when the deposit matures, does it transfer from being a time deposit to a demand deposit?
Yes, of course. The idea is that when the deposit matures on the day of maturity, it becomes immediately demand deposit. Now, some banks will say that you can withdraw it in the next 2 days. And if not, it rolls over into another deposit. For example, again, this is the type of the arrangement of the particular commercial bank. One commercial bank will have one practice. A whole bunch of commercial banks in Russia may have a completely different practice, and still the practice in the United States may be radically different. It may be typical to have a monthly deposit where it just matures in a month. If you don't withdraw it on the day of maturity, it immediately rolls over into another monthly deposit. So you can always withdraw it on the 1st, but if you're late on the 2nd, you can't. Okay? Now, in Bulgaria, the time deposit is somewhat of a hybrid. Technically and legally, it is a demand deposit, because they say, okay, it's a monthly deposit. You could withdraw it in the middle of the month, but you will lose your interest. All right? So if you want to earn your interest, you gotta hold till maturity. So strictly legally and technically, In Bulgaria, at least, all time deposits are, by their nature, demand deposits. But this is because it is the contract, and this is the custom in the Bulgarian banking system. But it doesn't have to be that way in Russia, or in Poland, or in any other country. In the United States, time deposits are strictly time deposits, and usually the bank will do it as a courtesy. They say, okay, you've been a good customer, we got some cash, meaning we got reserves, we're not in trouble, we'll give it back to you. You know, 2,000 deposit isn't going to hurt us anyway. So they may do it as a courtesy, but they don't have to. But in Bulgaria, they must. All right? Is this clarified? All right, so commercial banks demand deposits, which the textbook calls demand deposits of the commercial bank. All right, so these three are the components of money supply. Now, let's try some more. Commercial banks will keep deposits at the central bank. Do these deposits count as the money supply? And the answer is no. Remember the picture that we had here, a note, and that note was backing a coin of gold. The gold was in the vault. Remember that picture from before? And if you put the gold in the vault and the gold doesn't circulate, the note circulates instead. The money supply is only the note, but we don't count the gold. So this gold here represents reserves. And remember, in this particular case, the reserves don't count as part of the money supply. It is identical situation with the reserves of commercial banks deposited at the central bank. These reserves do not also count as part of the money supply. Okay? That's because, again, we, the people, meaning the public, businesses, cannot use those reserves immediately to make a payment. First, the commercial bank has to withdraw it, and then usually the withdrawal will create banknotes, okay? In central bank, when a commercial bank, you walk in and say, hey, we got a deposit with the central bank for 1 million. Of course, the central bank will print up 1 million to satisfy the deposit. And then the commercial bank loans the money, only then the banknotes are in circulation, and only then they become part of the money supply. Is that part fairly clear? Alright? So, now we have this part of the money supply. So the note here is reserves. Oh, is it time, guys?
Yeah. Yes.
Don't count. And let's provide last piece with which we finish today. Well, then ultimately the money supply is simply determined by whatever the reserves are in the monetary system. And the money supply equals the multiplier of the reserves. So reserves multiplied by the multiplier. And actually, believe it or not, I am done with everything I wanted to do for today, and the chapter is gone. All right.